We're just waiting for that last surge of silver over gold. It's going to end somewhere around 15 to 1. We don't know exactly when, but my guess is there's a bank crisis of some sort. The Fed cuts to zero, starts QE again, and then the metals just go up, limit up one day, limit up day 2, limit up day 3, limit up day 4. It's going to be like the end of 1979, the beginning of 1980, except this time there's going to be no correction back down. The monetary demand for silver is starting to wake up, and the silver market is not structured for that. It's structured for silver as a commodity, and it doesn't have the capacity to satisfy the demands of people that are demanding silver suddenly as money because they're panicking.
In every great monetary upheaval, there comes a moment when silver stops behaving like a commodity and starts behaving like money. According to market analyst and economist Rafi Farber, that moment is now within reach. He argues that the gold-silver ratio, currently hovering around 80 to 1, will eventually collapse toward 15 to 1, echoing the extremes seen during the monetary reset of 1979 and 1980. In Farber's view, this next phase won't be driven by industrial demand or speculative trading, but by panic, monetary demand returning to silver as faith in paper assets evaporates. When the next banking crisis hits, and the Federal Reserve is forced to slash rates to zero and restart quantitative easing, he believes we'll witness consecutive limit-up days in precious metals, with no correction afterward. The fundamental structure of the silver market simply isn't designed for this. For decades, silver has been treated as an industrial input, its price suppressed by futures contracts, and its availability dictated by industrial cycles. But the moment investors and institutions begin viewing silver as money again, that structure will snap. The supply side cannot meet the kind of demand surge that occurs when financial participants scramble to preserve purchasing power. As Farber emphasizes, this will mirror the end of the 1970s, except this time, there won't be a return to normal. Fiat credibility has run its course, and the monetary system itself is showing fractures too deep to paper over. In this video, we'll explore Rafi Farber's analysis of the coming endgame, how the Federal Reserve's tightening cycle has set the stage for an unprecedented liquidity squeeze, how gold's strength signals a coming policy reversal, and how silver is poised to lead the next leg of this monetary transformation. Farber has been one of the few voices consistently connecting the dots between money supply mechanics, the repo market, and precious metals behavior. His warnings are grounded not in speculation, but in a deep understanding of how credit and liquidity interact in a fiat-based system. If you find this analysis valuable, please take a moment to like this video, subscribe for more content like this, and stay tuned till the end. We're just getting started. We appreciate the support and hope you enjoy the video.
I think the most important point here is to take a step back and to realize that we are not yet in the final sprint to the end game because the next printing round hasn't even started yet. Right? The reverse repo extra money bank has been depleted, but the Fed hasn't stopped QT, hasn't stopped shrinking its balance sheet. It's slowed it down, but it hasn't stopped it. It hasn't cut rates to zero, and it hasn't started buying bonds net yet. It's just nothing is happening. And the fact that gold has gone so far so fast before the next printing round has even started kind of surprised me. So my point is that gold is not going to go up and up and up and up every single day until the next printing round starts. I mean, just like it was in COVID, the Fed cutting to zero immediately because there's a bank scare, or JP Morgan says they have to, whatever it is, the big banks come together and say, Fed, we need you to move. And then they print twice, 3 times, 4 times as much money as they did during COVID. Then gold and silver should go up and up and up day after day after day without any kind of pullback at all. But we're not there yet. So until we are there, the dollar is going to be in a perpetual short squeeze, meaning there's always more debt than dollars exist. So at the point when somebody starts defaulting, then you have, it's like a game musical chairs where the music stops and everybody's got to sit down, and whoever sits down last doesn't get a chair. So when the music stops and defaults start, that's when there's a rush for dollars, and there's going to be a big rush for dollars at some point, and gold and silver are going to sell off just like everything else. It's just that gold is going to sell off less than everything else, just like it did in COVID. Gold sold off during the lockdowns. It did. And it reached a low of 1450, and the miners got clobbered, I don't know, 20, 30, 40% in a few days. I don't know if it's going to be that magnitude this time. It's going to be the same kind of thing. and then the Fed's going to reinflate. And then at that point, we can say we're in the final sprint. It's going to take a few weeks until the dollar collapses, but we're not there. We got to wait for that to happen. And meanwhile, we can play the game of, well, what was the proximate cause that made gold and silver fall down specifically on October, whatever it was, 21st. And then we could look at the movements in the market, but that's all inevitable. It's always the same story. There's going to be something that is going to cause a correction until the Fed reinflates. So wait for that to happen, and then you can say that there's going to be no more corrections. But until then, you got to stay balanced. We can't be too euphoric, and we can't be too discouraged, because we're still in a dollar short squeeze where there's more debt than dollars that exist, and that's what's going to happen.
We saw a little bit about performance on that last leg by silver, but really gold and silver moved together for the most part. So that signals that we aren't at a blow-off top stage. Can you share a little bit about this, the gold-silver ratio, and what that signals to where we are in the bull market?
Yeah, you can come up with 1,000 reasons why it happens. But before we go into the reasons why, we just have to remember that this is what has happened every time since 1918. Since the end of World War I, which was the end of a huge inflation that funded the Great War back then. And then at the end of that inflation, silver outperformed gold until a silver dollar was worth more than a gold dollar. Not that silver was worth more than gold, but if you had a silver dollar coin versus a gold dollar coin, I think they had those coins back then the silver dollar was worth more than the gold dollar. So it was 1918 was the first time this century. You had it in 1968, 1980, 2011. Every single time there's some sort of a monetary reset, minor or major, then silver always handily outperforms gold. Like, obviously, like, what's that word? Not sporadically. Like in a frenzy. There's just a huge bid for silver, and we didn't see anything near that at all. Like, we were applauding, and we were like, giving a nice little polite round of applause to silver when it finally caught up to the rate that gold was rising, and even that wasn't every day. And so maybe since since August or September, silver has very slightly outperformed gold. But so it went from a ratio of like 107 to 1 in April to now 80 to 1 a few days ago. So okay, fine, it's a little bit of an outperformance, but you're counting from 107. That's not a normal ratio. So whatever is happening now, it's not an intermediate top. If it is a major top, it would be like any of the other ones that we've experienced since 1918. If you want to go into the why, it depends where your vision is most keen, what aspects of the gold and silver market you connect to or you look at, are you able to analyze the best. And I'm always broadly monetary. So whenever silver outperforms gold, it's a signal that credit is breaking down. And either the Fed intervenes and it saves the credit market by adding more credit. Adding more credit means adding more debt, because it's the same thing. Credit and debt are two sides of the same coin. So if the Fed's able to add more credit, add more debt, and then it's like a borrower who you're demanding he pay you back, and then he gets more credit from someone else, and he's able to pay you back in credit, and you're like, okay, fine. So I'll extend the term on your loan, and you'll keep giving me this credit. So that's what the Fed does. It just keeps extending the loan. So as long as it can do that, it can calm down the money markets and expand the credit markets. But when silver outperforms gold, that means either the Fed has to reinflate and suppress the monetary prices in terms of credit, or it's done. And this time they'll try to reinflate and it won't work. It'll be done. And we're just waiting for that last surge of silver over gold. It's going to end somewhere around 15 to 1. We don't know exactly when, but my guess is there's a bank crisis of some sort. The Fed cuts to zero, starts QE again, and then the metals just go up, limit up one day, limit up day 2, limit up day 3, limit up day 4. It's going to be like the end of 1979, the beginning of 1980, except this time there's going to be no correction back down.
When Farber says we're not yet in the final sprint, he's referring to the fact that the Fed's next printing cycle hasn't even begun. Despite gold's surge, quantitative tightening remains in place, balance sheet reduction continues, and interest rates haven't been cut to zero. This means the system is still in a dollar short squeeze. There are more debt obligations than dollars available to settle them. Historically, such imbalances always resolve in one of two ways: mass default or monetary expansion. Farber suggests that when defaults begin and the panic phase takes hold, the Fed will be forced to intervene, this time on a much larger scale than during the pandemic. That's when the parabolic rise in precious metals begins, And when silver's outperformance over gold signals that the credit system is breaking down for good. This brings us to the deeper problem Farber highlights in the next segment. The reverse repo market has effectively run dry. What once served as a liquidity buffer outside the banking system has been depleted. The Fed's tightening is now directly draining reserves from banks, leaving them to compete in an already strained repo market where trillions are traded nightly. As rates wobble and liquidity tightens, even the Fed's emergency repo facility, designed to stabilize short-term funding, is being tapped again. In such an environment, precious metals and even alternative assets begin to act as collateral substitutes. It's not just about gold or silver anymore. It's about the system's ability to maintain trust in fiat liquidity itself. Let's get back to the interview.
So the reverse repos are done. There's practically no more of them. I think the last one was like 3 billion, which is basically nothing. So the quantitative tightening, the QT, the shrinking of the balance sheet that the Fed has engaged in since it started at the peak of the balance sheet was sometime in 2021 for the last 4 years, maybe 2022. I don't remember. It's all blurring together. All this COVID and the printing and AI, it's all kind of like mushing together in my head. Whatever's happening in the world. So since the Fed started QT, they've been shrinking effectively the reverse repo amount, which is money that's outside of the banking system, and now it's no more. So all the QT it has been draining bank reserves, and bank reserves are used as the grease, as the slime that coats the repo market. That's the money that's being traded. Those are the dollars that are being traded every night, 3 trillion of them, the bank reserves. Now, I had a theory that ultimately proved wrong. I don't think it's in principle wrong. I just think that I missed a technical aspect that I suspected I might have missed, but I didn't really take it seriously. I thought that the amount of reserves could not be less than the amount of repos that are traded every night because they're trading the reserves. So it turns out they can. I just don't know by how much. I don't think by that much. So right now the ratio the bank reserves are falling. They're now at like 2.9888 trillion, like below 3 trillion. And this week's number, which should be out in a few hours, and in 2.5 hours it'll be out, and I'll check it. It should be like something like $80 billion less because the government shutdown, right? It means that the government isn't spending as much money. It's spending, I think, on mandatory spending, but not on discretionary or something like that. I don't know exactly what the technical details are, but it's spending less money than it otherwise would. So all the money that's sucking out of the bank system is not being spat back into it. So they're raising money. I think the total dollar cash hoard that they have is like $930 something billion. It was whatever it was like 60 or 70 billion dollars more than it was last week. So that's money that's taken from reserves. So yeah, now you have 2.988 trillion minus about 70 billion. So it's like 2.91 trillion or something. And the amount of repos that are being traded is over $3 trillion. It's like 2.98. It fluctuates between like 2.95 trillion and 3.0 or 3.1 trillion, something like that. Like how much longer can this go on? I mean, we're looking at the repo rate. It's called the SOFR rate, and it keeps wobbling. It wobbled again 2 days ago, up 7 basis points, and now it was down 3, and tomorrow could be up 10. Who knows? If it's already wobbly, that means things are already tight. And the standing repo facility that the Fed instituted after COVID, it provides emergency repo money to banks that can't get it because maybe the reserves have run out. It's being used. And sparingly, like a few $1 billion a night, but it is being used now. It wasn't being used before. So we know that some banks are out of reserves, so they can't get any. So there is a shortage here. It's going to get worse as repo trading keeps expanding as it does, because you have all these hedge funds that are, I don't know, trying to pick up pennies with basis trades. I don't even want to go into the technicals of that. It's just you're trading around dead zombie money and earning a few pennies on levering it up like 50 times each night. So this is going to end. And it's going to end soon because the repo rate is already moving several basis points a night. It's already tight. If you read these books on hyperinflations, isolated hyperinflations in the world, I remember reading once, maybe it was When Money Dies. I forgot who the author was, but it was about Weimar. And he was talking about during the late 1923, when the hyperinflation was in full swing, you had government agents of the Weimar Republic just like raiding people and stealing whatever hard money they had on them to try to get ahead of the hyperinflation, where they had gold coins in their pockets or silver coins. And they even outlawed platinum because some people were hoarding platinum and using platinum for exchange because they couldn't use the stupid paper mark. That is like, so even back in 1923, platinum was still being hoarded as some kind of a money, as some better money than paper money. So the reason platinum would be disjointed, not necessarily because there's a sudden demand for catalytic converters or whatever, is platinum is used for primarily. And that's primarily catalytic converters in cars and other strange niche kind of things that I really have no understanding of. I don't understand car parts or anything like that. But since it is a pseudo money and the liquidity is so low, people could think, well, gold's too expensive. It's like $4,400 an ounce. I mean, there's probably a little bit of a physical premium on it. To get an ounce would probably be $4,400 today, despite the fall. And they might get some silver, but they might also want something that's more value dense just to preserve their wealth. And they don't want gold, and they think the platinum is really cheap because, they think of the 90s and like, okay, well, platinum was much more expensive in the 90s than gold was. That's why like the platinum credit card is considered a higher line of credit than the gold credit card. And, that's left over from that decade. So in their mind, platinum could be more valuable. And as markets shift from industrial to monetary, industrial demand is demanded by the creators of whatever piece of capital equipment they're producing for industry, right? Or consumer good. But monetary demand is by definition everyone. So even the slim amount of monetary demand would be more than the very specialized industrial demand for platinum. If you have even a tiny percentage of monetary wake up of people looking for a preservation of value, and they don't want gold because it's too expensive, then they'll see platinum is cheaper, so want to take that. Maybe they'll go for it. And that could overwhelm the very, very thin platinum market as it's overwhelming the silver market, which is why you're seeing all this disjointing through London and New York. What that means just very broadly in a broad brush strokes is that the monetary demand for silver is starting to wake up, and the silver market is not structured for that. It's structured for silver as a commodity, and it doesn't have the capacity to satisfy the demands of people who are demanding silver suddenly as money because they're panicking.
As Farber notes, this stress isn't isolated to gold and silver. We're seeing distortions in platinum and other niche metals, signs that monetary demand is seeping into traditionally industrial commodities. During past episodes of hyperinflation, such as Weimar Germany, people hoarded not only gold and silver, but even platinum to preserve value as paper currencies collapsed. The same psychological shift may be underway again. As gold grows more expensive and physical silver becomes harder to source, capital may start rotating into other scarce tangible assets. The awakening of monetary demand across the commodity complex signals that the fiat era is running on fumes, and that a full repricing of real assets is coming. For investors, this dynamic is profoundly bullish, not just for precious metals, but also for decentralized assets like Bitcoin. When confidence in fiat erodes, anything outside the traditional credit system starts to rise. Gold and silver will lead the charge, but crypto markets could follow as the next generation of digital hard money. The collapse of the dollar's synthetic liquidity will not end speculation. It will redirect it into assets that hold intrinsic or algorithmic scarcity. We are entering the terminal phase of the current credit cycle. Whether it unfolds gradually or through a sudden shock, the outcome will be the same: a reset of value back to hard money principles. If you believe in understanding these shifts before they happen, make sure to like this video, share your thoughts in the comments, and subscribe for weekly breakdowns of what's really happening behind the headlines. Thank you for watching.